Let's explore some of the most common terms used by Forex traders and what they mean. Bullish. The term bullish means that investors are expecting prices to rise. So, when we hear that a trader is bullish on EUR/USD, it means that he is expecting the EUR/USD chart to rise. Bearish. The term bearish is the opposite of bullish. It means that the investor is expecting prices to drop. So the term "I'm bearish on EUR/USD" means that the trader is expecting EUR/USD to drop. Safe haven. This usually means the assets that investors turn to during times of market volatility and instability, perceived to be safer, especially amidst market turmoil. Examples include the US dollar, gold, and bonds. Other safe haven currencies include the yen, JPY, and franc, CHF. High beta currencies. These are traditionally volatile currencies with larger price fluctuations. Examples include AUD, NZD, CAD, EUR, and GBP. Risk-on and risk-off environments reflect investors' confidence in the markets and their risk appetite. In a risk-off environment, investors are more cautious and risk-averse, seeking safe haven currencies such as USD, JPY, and CHF, and selling high beta currencies such as AUD, NZD, GBP, EUR, and CAD. Conversely, in a risk-on environment, investors have a larger appetite for risk, benefiting high beta currencies while safe haven currencies suffer. Bid and ask prices. Bid and ask are very common trading terms. Essentially, the bid price is what the broker is paying for a currency, while the ask price is what the broker is selling for a currency. How does this apply to us as retail traders? Well, we always look at the ask price when buying a currency pair and the bid price when we want to sell a currency pair. To better understand this, let's look at Aiden, an American visiting the United Kingdom. As he has no cash on hand, he needs to exchange his USD for GBP to spend. Upon arriving at the currency exchange, he found the rates as follows. How do we interpret this? First, given that Aiden wants to buy GBP in exchange for his USD, we need to look at the ask price. The ask price of 1.3000 means that 1 GBP is equal to 1.3000 USD. Hence, if Aiden wants to buy GBP 30,000, he would have to pay the dealer USD 39,000, 1.3000 x 30,000. Suppose now that the next traveler, Jane, has just returned from her vacation in the UK. She has 30,000 GBP left and wants to exchange them back into USD. With reference to the rates above, she is intending to sell a currency pair, hence she should be looking at the bid price. A bid price of 1.2900 means that 1 GBP is equal to 1.2900 USD. So if Jane wants to sell 30,000 GBP, she would receive USD 38,700, 1.2900 x 30,000. In both examples above, we saw that the same 30,000 GBP yields a different value in USD. This is because of the difference between the bid and ask prices, which is also known as the spread. Because of this spread, the dealer was able to make a profit of USD 300 from this transaction, USD 39,000, USD 38,700. As we can see from above, the bid-ask spread is always advantageous for the market maker. How is the spread relevant to traders? Wide spreads are the bane of the retail currency exchange market, since it increases your cost when trading. However, you can mitigate the impact of these wide spreads by researching brokerages that offer low bid-ask spreads. Another way you can easily determine your bid-ask spreads is through your MT4 or MT5 trading platform. We'll explore the MT4 platform in detail later in this series. As shown below, when trading on your broker's MT4 platform, you will be able to directly view the bid-ask spread of a specific market in the Market Watch window, as well as in a small window with one-click trading enabled. To see the spread, simply right-click within the Market Watch window and click on Spread. As you can see, the bid price in the bid column is labeled as sell, since it is the price the dealer will pay you for the currency. For example, when you decide to open a short position in the USD market, you will sell at the bid price. The ask price in the ask column is labeled as buy, since you pay this price when buying a currency from the dealer. For example, when you decide to open a long position in the USD market, you will buy at the ask price. The column labeled refers to the spread. Note that the spread is denoted in points. To see the spread size in pips, you will need to divide the spread numbers by 10. See more on this in the following section. In a nutshell, when faced with a standard bid and ask price for a currency, the higher price is what you would pay to buy the currency, and the lower price is what you would receive if you were to sell the currency. Liquidity describes the degree to which an asset can be quickly bought or sold in the market. If a Forex pair is liquid, it means that there is a high trading volume, which also means that there are a lot of people buying and selling the currency at the same time. Slippage is the difference between the expected price of the trade and the actual price at which the trade is executed. While it can occur at any time, it is most prevalent during periods of higher volatility when market orders are used. Pips and points. A pip is short for percentage in point. It is also the minimum price fluctuation possible in a Forex transaction. It is typically the last decimal of a currency pair's quoted exchange rate and is equal to 0.0001 for most currency pairs. Most pairs go out to 4 decimal places, but there are some exceptions like Japanese yen pairs that go out to 2 decimal places, also sometimes called a point. For clarity, let's look at an example using the GBP-USD pair. If GBP-USD moves from 1.2950 to 1.2951, that results in a 0.0001 change, 1.2951, 1.2950, which is equivalent to 1 pip. The above scenario applies to almost all currency pairs except Japanese yen pairs. For Japanese pairs, 1 pip is equivalent to 0.01. As an example, if the EUR-JPY pair moves from 122.50 to 122.51, that results in a 0.01 change, 122.51, 122.50, which is equivalent to 1 pip. For oil prices, consider a pip in crude oil to be 0.011. That means a $1 price fluctuation in the oil price is equal to 100 pips. Let's expand on that with the example of a 10-barrel contract. 10 barrels x 0.01, 0.10. This is the pip value for trading accounts denominated in US dollars. Similarly, for gold, it's better to think in dollars and cents, not pips. Technically, a pip is 0.01 or 1 cent. If you trade 0.01 lots and price goes 1.0 in your favor, you make 1.0. In terms of indexes or indices, let's assume you sell the SPX index at 2886.30 and close the position at 2694.10. This would leave us with 192.2, 2886.30, 2694.10 points in profit. Given that 0.01 euro $1 point and 0.01 euro 0.10 pip, this trade would have made us 192.20 in profits, which is 1922 in pips. So what about points? Well, a pip is the equivalent to 1 basis point. For example, the smallest move the USD CAD currency pair can make is 0.01 or 1 basis point. Long and short. When investors hold a long position, it means they are buying a currency with the expectation that it will increase in value over time. Conversely, a short position involves selling a currency expecting its value to drop over time. The term bullish means that investors are expecting prices to rise. So, when we hear that a trader is bullish on EUR-USD, it means that he is expecting the EUR-USD chart to rise. Hawkish and dovish are basically terms used to describe the stance of a central bank. If a central bank is said to be hawkish, it means that it foresees higher future interest rates, which in turn cause the currency to move higher. On top of that, it also means they are positive about the economic growth and expect inflation to increase as well. Conversely, if a central bank is dovish, it means they foresee lower future interest rates, which in turn cause the currency to move lower. Lot size. Trading on the FX market is usually conducted in specific amounts known as lots. These are units of the currency that you intend to buy and sell. The common lot sizes offered by brokers include standard, mini, or micro lot sizes. So what's the difference? Well, a standard lot represents 100,000 units of any currency, whereas a mini lot represents 10,000 and a micro lot represents 1,000 units of any currency. On the MT4 platform, you can select a default number of lots when you open a position, making it more convenient for placing same-size trades quickly. To set this up in MT4, simply hover over Tools and then click on Options. Once there, select the Trade tab and check the default bullet under Size by default. Now you can choose the specific number of lots you want to trade with all the time. Then click OK once you're done. Pip and profit calculation. Now that we have learned how to calculate the number of pips, let us learn what these numbers mean in profits. First, we need to determine the value per pip here. Value per pip in base currency, 1 pip, lot size, exchange rate. Assuming that you are trading one standard lot of USD JPY, value per pip in USD or 0.01, 100,000, 110.673, 9.03 per pip, profit in base currency, 1 value per pip, number of pips, lot size. Continuing from the example above, if we buy USD JPY at 110.673 and close the trade position at 110.973, that gives us 30 pips of profit, 110.973, 110.673. To calculate its value in dollars, here's how we can calculate it. Profit in USD, 9.03, 30, 1, 270, 90. For every currency pair that ends with USD, for example, EUR USD, GBP USD, AUD USD, NZD USD, the calculation is much simpler. These are the corresponding values per pip in USD based on the different types of account. How can we apply this? Assuming we are buying EUR USD with the following details: entry 1.0500, take profit 1.0800, lot size 0.50, account type standard lot. This gives us 30 pips in profit calculated as follows: 1.0800, 1.0500, 0.0001 are 30 pips. Since the pip value is $10 for every pip in a standard lot account, that gives us a profit of $300, $30 pips x 10 pip. 2.2 Major, minor and exotic currency pairs. Major currency pairs. The major pairs are the most heavily traded currency pairs in the FX markets. Given the huge volume of transactions that occur daily, the liquidity translates to lower bid-ask spreads for traders. At the same time, there is also a lower chance of slippage, or at least large slippage, occurring, as there are more people in the market willing to buy and sell simultaneously. However, slippage can be common among exotic currency pairs as they are less liquid. Major currency pairs include EUR, USD, GBP, CHF, CAD, AUD, NZD, and JPY. It also refers to any pair containing one of these currencies and the US dollar. They are also known as the G8 currencies due to high liquidity, which means that there is a huge volume of the currency being traded at any point in time. Examples include EURUSD, GBP USD, USD KD, AUD USD, USD JPY, and NZD USD. Minor, exotic, and emerging currency pairs. Currency pairs that are not associated with the US dollar are referred to as minor currencies or crosses. These have slightly wider spreads and are not as liquid as the majors, but they remain sufficiently liquid markets. Crosses that trade with the most volume typically include individual currencies that are also majors. Some examples of crosses include the GBP JPY and EUR JPY. Exotic currencies are emerging market currencies. As these pairs are not as heavily traded as the G7 major currencies, they have much wider spreads compared to major or minor currencies. Some examples of exotic and emerging currency pairs are CNH, Chinese renminbi, ZAR, South African rand, and BRL, Brazilian real. Tokyo, London, and New York sessions. One of the amazing things about the Forex market is that it's open 24 hours a day, 5 days a week. A 24-hour Forex market offers opportunities for traders worldwide because of its liquidity and trading opportunities. This usually means the assets that investors turn to during times of market volatility and instability perceived to be safer, especially amidst market turmoil. Examples include the US dollar, gold, and bonds. Other safe haven currencies include the yen, JPY, and franc, CHF. Tokyo session. The Asian session kicks off the Forex market at the start of a fresh week. This session encompasses countries such as China, New Zealand, Australia, and Russia. Liquidity is generally lower compared to the US and London sessions. The Asian session runs from 11 p.m. to 8 a.m. GMT. London session. Before the Asian trading hours end, there is a 1-hour overlap with the European session. This overlap includes other major markets like Germany and France before the UK officially opens. European hours typically run from 7 a.m. to 4 p.m. GMT. New York session. The New York session runs from 12 p.m. to 8 p.m. GMT. It is characterized by high volatility due to its few hours of overlap with the European session. The activity is dominated by the US with contributions from Canada, Mexico, and South American countries. It is all for now. Make sure to subscribe and turn on the notification bell for future video about picking your broker.